Hello everyone and welcome to another options trading educational video from OptionsPath. Today we're going to give a quick introduction to a popular undefined risk options trading strategy called the short strangle. Now short strangles are simply a combination of two short options positions, one out of the money short call above the market price and one out of the money short put below the market price. A short strangle is a bit similar to its defined risk cousin, the iron condor, in that you're hoping the price of the underlying stays between the two sides of your trade. If you want to learn more about iron condors, we've done a past video that explains the iron condor in good detail. We also have a video that explains selling or shorting puts for income, which is one half of the short strangle I'll be talking about here. The link to those videos is in the description area below. As I mentioned, a short strangle is a strategy that involves selling out of the money calls above the current market price and out of the money puts below the market price. Keep in mind that these positions do not need to be opened simultaneously. The short puts and calls can be opened at different times according to market conditions. Once a strangle is sold or shorted, the strangle seller immediately earns from the buyer or buyers the combined premium of the sold calls and puts. The ultimate goal for the seller is to see the underlying instrument expire between the short call strike price and the short put strike price. The maximum profit on this trade is, as mentioned, the total premium received, while the max risk is theoretically unlimited. If the underlying either goes above the short call strike or below the short put strike, losses will progressively escalate. If this happens, unless you're trading a market index like the SPX, you can also be assigned positions in the underlying, a long stock position in the case of the short put, or a short stock position in the case of the short call. Now let's take a look at a risk graph of a strangle. Here's the P&L graph of a strangle. Now, while the strangle is one of the top income-producing strategies available to options traders, some may not wish to assume the undefined and theoretically unlimited risk profile. Others may not have the capital in their trading accounts to comfortably cover their margin requirements of strangles, as this strategy is much more capital intensive than defined risk strategies. For many such traders, the iron condor, a very similar but defined risk strategy, is the clear alternative. Again, the link to our iron condor introduction video is in the description area below. Okay, to finish up this intro to strangles, let's give a quick example. Here I have my chart of SPX, which is the S&P 500 index. As you can see, at the current time of this video, we're entrenched in a very sharp rally. While we're not currently actually looking to place strangles on this market due to the high potential for further upside momentum risk in the near term, I'll just use this market to illustrate the strangle. Here I've chosen a short out of the money call above the current price, right up here at 23.25, and the current price is around 22.59, as we can see right here. So here's my short call above here at 23.25, and then I have a short put down here at 21.65. So these two short options are framing price. Again, you do not need to place both sides simultaneously, but I've done so here just to illustrate the entire trade. Okay, so the goal here is for the underlying SPX to end up between the two short strikes by the end or expiration of the trade. If this happens, you will earn the premium you received for selling the calls and puts. If the price of the underlying breaches either side, though, that's when losses accrue. Now, one thing should be kept in mind here. If the underlying does in fact closely approach either side before the end of the trade, there is much that can be done to adjust or manage the trade. Trade adjustments will be crucial in helping to minimize risk and maximize potential profits. We'll talk more about adjustment techniques in other videos, as they're a bit beyond the scope of this intro video. Okay, so now that we have a visual interpretation of how strangles work, let's go to the order page to illustrate how to place strangles. So I have my order page here with the SPX options chain open, as we can see right here. I'm choosing an expiration date around a month out, as we can see right here with the 33 days. Now I'd simply scroll down to find my strikes, and right here, as we can see, I've already chosen my two strikes. I have my call strike right up here at 23.25 and my put strike right down here at 21.65. Now to open this strangle, I would simply right click on one of them, and in this case I'm going to simply right click on the short call chain right here and then go to sell because this is a short options position, and then I could go to strangle right here and out pops this window. Now here we have my 23.25 short call. In terms of the put, right now it put in a default, but I'm going to simply go down to the 21.65, which is the strike price that I chose for my short put. And we're going to go right over here to 21.65. Now, as we can see, the total credit that I will receive at the current price is around $12.30, which is a significant amount for this particular strangle. And then over here, I could choose how many lots I want to trade, and then also I could change my price right here to try and get filled on this particular order. And when I'm done with that, I simply click on confirm and send, and then we have our strangle in play. Okay, so there you have it, just a quick and simple video on trading short option strangles, a potentially high probability and high income strategy with undefined risk. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward. From all of us at OptionsPath, thank you so much and have a great day.